How can investors navigate economic uncertainty? Here's a broader market perspective. Market sentiment has turned cautious as both the S&P 500 and Nasdaq indices show negative performance year to date. While trade tensions dominate headlines, other factors, including declining consumer sentiment, elevated inflation readings, public sector job reductions, and various economic indicators have contributed to market anxiety. With recession concerns resurfacing and President Trump acknowledging their possibility, investors seek guidance on maintaining perspective during these uncertain times. It's crucial to differentiate between personal economic experiences and market dynamics. While rising prices for goods and services may strain household budgets, they can create investment opportunities in certain sectors. Successful investing requires separating emotional responses to economic conditions from the fundamental factors that drive investment performance over time. The economy and financial markets share a complex relationship. Strong economic growth typically supports corporate earnings expansion and higher equity prices. Markets can also function as economic indicators, reflecting the collective wisdom of countless market participants. However, market predictions aren't infallible. Recession forecasts have persisted for nearly 3 years, with many experts incorrectly anticipating an economic downturn due to inflation just last year. Traditional recession indicators like yield curve inversions and the SOM rule have proven less reliable in the current cycle. In fact, markets have demonstrated remarkable resilience. Despite recent declines, the S&P 500 has advanced more than 60% from its 2022 lows, while the Nasdaq has surged over 75%. Though a recession will eventually occur, accurately timing economic shifts remains challenging. Building portfolios aligned with long-term objectives rather than attempting to time economic cycles typically produces better outcomes. Recessions typically emerge during late cycle conditions or following external shocks like financial crisis or pandemics. While current economic indicators suggest slowing growth, we haven't entered contraction territory. Trade tensions represent an external risk factor affecting consumer confidence, business operations, and global supply networks. The administration has acknowledged potential economic turbulence ahead. This chart illustrates that policy uncertainty has increased, particularly regarding trade measures implemented more aggressively than in the previous term. The ultimate impact remains unclear, with possible outcomes ranging from historic tariff levels to negotiated resolutions. Trade actions often serve broader strategic objectives. Historical evidence suggests market reactions to tariff announcements frequently exceed their actual economic impact. During 2018's trade tensions, markets initially declined, but the economy maintained nearly 3% growth with robust corporate earnings. While uncertainty creates market volatility, strong economic foundations can help absorb policy changes more effectively. Beyond trade issues, several economic indicators have raised concerns. Inflation has re-accelerated above 3% for the first time since mid-2024, while employment data shows mixed signals. Federal government employment declined by 10,000 in February, with more reductions expected. Consumer sentiment has deteriorated, with 5-year inflation expectations reaching 3.5%, the highest since 1995. This has contributed to pessimistic outlooks on future financial conditions. Interestingly, markets seem to have overlooked potential positive catalysts, including manufacturing initiatives, energy policies, tax reforms, and regulatory changes. Consumer spending has been a key growth driver, and some economists anticipate additional support from business investment. Congressional discussion continues regarding extending the Tax Cut and Jobs Act, while regulatory reforms advance. Economic slowdowns represent natural cycle progression. However, forecasts often miss the mark, and market responses can defy expectations. Recent examples from 2020 and 2022 demonstrate markets' capacity for rapid sentiment shifts and recovery. Market pullbacks remain a fundamental aspect of investing. This chart illustrates the S&P 500's history of regular corrections within its long-term upward trajectory. Maintaining this broader context helps navigate periods of economic uncertainty. The bottom line, while recession concerns have intensified amid trade tensions and mixed economic signals, successful long-term investing requires maintaining perspective. History demonstrates that staying invested through challenging periods typically rewards patient investors. As Warren Buffett once said, the market is a great mechanism for moving money from the impatient to the patient.